Welcome, everybody. I am very happy to welcome you to, on behalf of the Worldwide ESG Working Group, to our international webinar on European ESG regulation and implementation. At McDermott, we have seen ESG affecting almost all our practice areas. We are dealing with existing and proposed regulatory requirements and with voluntary industry and other non-governmental standards and frameworks. We are working on ESG-related matters in energy, in capital markets, in public companies, insurance, private equity, investment funds, environmental law, sustainable finance, transactions, and so on. We have reacted quite early and combined our expertise in an international ESG team and working group. It is thus great to see that our ESG team collaborates across our offices around the world. And I'm happy to see every day that we are able to bring excellent practitioners in all relevant areas worldwide to our clients. So please, whenever you have a question, do not hesitate to reach out to us. We are always able to bring you together with the required specialist for your particular issue. My name is Frank Müller. I'm a partner in the Frankfurt office of McDermott, specializing in investment funds and real estate. I'm also happy to introduce my colleagues Raminta and Philip. Raminta from our London office and Philip from the Düsseldorf office. As you can see, they have complicated family names, so I'll just stick to the first names. And both will lead you through this webinar today together with me. Raminta focuses her practice on product compliance, trade regulation, and ESG, and she has significant experience in advising on European Union and UK's chemical legislation, product safety, and liability rules. Philip, on the other hand, advises clients on all aspects of corporate law and merger and acquisition. Philip has extensive experience acting for financial and strategic investors and in private and public takeovers. Before we start, I would like to give you some technical information. Ideally, you should now see our presentation on your screen, and you should see me somewhere in the little top corner of your screen, and you should obviously be able to hear me. We have a chat and Q&A function on the bottom of your screen, so please feel free to ask any questions during the webinar by using those functions. From experience, however, we can tell that we might not be able to answer your questions during the webinar, or we don't have the time, as we want to finish on time and finish the webinar in 1 hour. In this case, please don't worry. We will follow up with you and your questions, and we will contact you after the webinar to answer your questions. We will, on the other hand, also record this webinar and send you the link as well as the presentation in the next days after the webinar. And in general, again, please feel free to contact us at any time whenever you have any questions, either via email or telephone, or come by to our offices. Our agenda for today. The agenda for today will be to give you an introduction to European ESG regulation and implementation. As you can probably imagine, this regulation fills currently thousands and thousands of pages. And we are still in the beginning of this regulation. And we only have 1 hour today. So obviously, we will focus on major developments and give you an overview on certain topics and an introduction into these topics. Again, if you want to go further into details, please feel free to reach out to us. Raminta will introduce to you the European Green Deal. Afterwards, I will explain to you something about the EU Action Plan and taxonomy and disclosure regulation. And Philip will finally explain the CSR directive. This is the program for today. We hope you enjoy it, and we hope that we will hear from you afterwards. Thank you very much for your participation, and Raminta, please.
Thank you very much, Frank. Well, it will be an enormous task to explain how many initiatives the EU Green Deal comprises of and how long we have been looking, or how short for that matter, as Frank pointed out, at legislative initiatives or legislation being amended. So on the next slide, I have set out where it all started and how did we get to 2021, currently COP26 that we keep on hearing about, And in fact, the European Union has been at the forefront of efforts to build a financial system that supports sustainable growth for a decade or over a decade. The Green Deal and sustainable finance packages are a culmination of the EU efforts for decarbonization and the development of a more sustainable economy. So it all materialized to a great extent in 2015, whereby two landmark climate agreements were concluded by international community. The UN Agenda, UN 2030 Agenda, and Sustainable Development Goals were launched with a main aim to end poverty in all its forms. The agenda is comprised of 17 sustainable development goals that you can see here on your slide, including climate-related goals, such as ensuring availability and sustainable management of water, ensuring access to sustainable energy, and the promotion of sustainable growth. That led on to Paris Climate Agreement, the landmark legally binding international treaty on climate change, which was adopted at COP21 in Paris. And it includes the commitment to align financial flows with a pathway towards low carbon and climate resilient development. Moving on to December 2019, EU Green Deal materialized. In line with the commitments under the UN and Paris agreements, EU developed a growth strategy aiming to make Europe the first climate neutral continent by 2050. UN 2030 Agenda and the 17 SDGs set out here form an integral part of EU Green Deal. In January 2020, to fund the Green Deal, the EU published the EU Green Deal Investment Plan, which will mobilize at least 1 trillion of sustainable 1 trillion euros of sustainable investments over the next decade. And EU 2030 Climate Target Plan was put forward in September 2020, whereby EU further increased its ambition to reduce greenhouse emissions by at least 55% by 2030, requiring an investment of at least 350 billion euros more every year during the 2021-2030 decade. As the scale of investment we're talking here about is too great for the public sector alone to fund it, the EU, alongside Green Deal, has introduced measures to attract private investment. And to this end, the EU has developed a strategy on sustainable finance that we will be talking about in this webinar. Here we are in November 2021, so Conference of Parties, number 26, which is the UN Climate Conference, is taking place in Glasgow. You no doubt would have heard a lot about it on the media. Countries have come together to update their plans for reducing emissions to achieve the targets set out in 2015 Paris Climate Agreement. That's likely to do very little for Europe, as Europe has already set out its most ambitious agenda in the world, plowing away with more than a dozen of initiatives that will be changed to achieve this carbon neutrality by 2050. Moving on to the next slide, I'd like to dive into more detail on what the EU Green Deal actually is. It, of course, outlines the EU's main growth strategy to transition the EU economy to a sustainable economic model. But actually, in effect, it is a document that we always refer to, a pledge of 20 pages that explains the initiatives that the Commission is presenting progressively since 2019. But in practice, it delves into more than a dozen areas where the Commission will introduce new restrictions, present new opportunities, or change existing legislation that will apply to industry directly or will be implemented at the member state level. As you see from the green list and graphics, all sectors of economy are involved, such as transport, buildings, agriculture, and energy production. It envisages to cover product life cycles and industry value chains from top to bottom, and ultimately transition to circular sustainable economy. Other sectors like finance have a role, of course, in directing private capital towards more sustainable investments. And all measures are interconnected and focused on achieving the primary goal of climate neutrality by 2050. The EU Green Deal is, as I said, most ambitious project of this kind. As Mrs. von der Leyen, the president of the European Commission, stated, and she put it very directly, this is Europe's man on the moon moment. And it really is, particularly for lawyers, investors, and those driving the sectors that will have to change 100%, because it really takes it from the roots and introduces a new model of how economy will function going forward. On to the next slide. We will look further into what these Green Deal initiatives are. And as I said, there's quite a few of them. So the first two deal with climate and are climate action as well as clean energy. Climate Action Initiative, as law, entered into force in July 2021. So very, very recent. The European climate law writes into law the goals set out in the European Green Deal for Europe's economy and society to become climate neutral. It is closely interconnected with a Fit for 55 package and initiative, which I list out here on the slide, and covers areas of climate, land use, energy, transport, and taxation to bring them in line with the targets agreed in the European climate law. Legislation, I'm afraid, does not stop here. Further proposals and amendments are expected at the end of 2021, and these include a revision of the Energy Performance of Buildings Directive and new climate, energy, and environmental state aid guidelines. Clean Energy for All Europeans package, on the other hand, has been published in 2015. This marked a significant step towards implementing Energy Union strategy, whereas the revised Renewable Energy Directive, which I list here, contains this commitment, and it entered into force in December 2018. Initiative package contains 8 legislative acts set out on this slide, and you would have heard a lot about hydrogen, both on the investment side as well as on technology and legislative side. The EU hydrogen strategy provides for 3 phases to increase production of green hydrogen and covers process, technology, and advancements, as well as sets out targets to achieve these. Moving on to the next slide and further initiatives, sustainable industry being one of them. So industry currently contributes to 20% of EU greenhouse gases emissions. The Green Deal includes actions to strengthen the decarbonization efforts, ranging from product sustainability to the supply of raw materials. 2 key initiatives of sustainable industry package cover Circular Economy Action Plan, as well as EU industry strategy. So Circular Economy Action Plan targets how products are designed, promotes circular economy processes such as reusability, repairability, recyclability. It encourages sustainable consumption and aims to ensure that waste is prevented and the resources used are kept in the EU economy for as long as possible. This is, from the professional sense, very dear to my heart. I work with this on a daily basis, looking at product life cycles, from mining to it becoming a product to recycling, and whether one product can be considered waste or not. All of this is being lifted up, reviewed, and will become new or amended legislation. Among other things, new regulation on batteries imposes mandatory requirements for all batteries. For example, industrial, automotive, electric vehicle, and portable. You'll hear a lot of that, just as you'll hear about hydrogen. And we're talking about products being placed on the EU market. So these cover use of responsibly sourced materials with restricted use of hazardous substances, minimum content of recycled materials, carbon footprint, performance, durability, labeling, you name it. There's a Buildings and Renovations Initiative as well, which is in the Green Deal. It aims to reduce building energy consumption, which is an ambitious program aiming to double the rate at which the block's existing building stock is renovated to increase their energy efficiency. Obviously, numerous regulatory instruments are proposed or being amended to achieve or implement or move forward the sustainable industry and buildings and renovations initiatives. But that doesn't just end here. So next slide, please. There is also sustainable mobility as well as eliminating pollution initiatives. A little bit about each one of them. Obviously, every initiative with how many directives and regulations are put forward could be talked about for nights and days moving forward. And what our forum will do for ESG, what our group will do moving forward, will focus on each individually in the future and will delve in depth at these proposals. For now, the European Green Deal includes a target to reduce transport-related greenhouse gas emissions. And to achieve this goal, the EU strategy for sustainable and smart mobility lays a foundation for action to transform the EU transport sector. So by 2050, nearly all cars, vans, buses, as well as new heavy-duty vehicles should be zero emission. Means that a lot of authorizations, a lot of technology will have to be changed, replaced, and new products will have to be placed on the market. To meet the targets of various legislation will be reviewed, and that includes energy performance of buildings directive, directive on the deployment of alternative fuel infrastructure, revision of the CO2 emissions performance standards for cars, vans, and lorries. Eliminating pollution, on the other hand, is an action plan that introduces pollution elimination measures in all policy developments. 3 key measures under the action plan are chemical strategy for sustainability to protect environment. A huge pressure as well as focus will be on the European Chemicals Agency, which will play a significant role on reviewing and putting forward new legislation, as well as dealing with national member state authorities on enforcing such new requirements. There's action plan for water, air, and soil as well, and pollution from industrial installations. And you'll see here on the slide, there's a little bit more detail for each one of us, but I will not go into more detail as we have a lot more to cover. Next slide. Last but not least, there's 4 more initiatives: Farm to Fork, preserving biodiversity, research and development, carbon leakage. A little bit more detail for each one of them on the slide. I'll focus on a few of them rather than covering all 4. So Farm to Fork aims to address environmental issues and greenhouse gas emissions in the food producing industry. And this is a fairly new initiative, meaning that it hasn't been lingering for 10 or 12 years as already existing regulations or directives. There's quite a few new legislative and non-legislative measures that Farm to Fork covers. And these include new methodologies for measuring food waste, funding for research and innovation of food, natural resources, agriculture, fisheries, and others. Research and Development Initiative underpins all technological developments required to achieve the Green Deal objectives. Horizon Europe, which is the EU's key funding program, will spend over 35% of its 95 billion budget on research and development initiatives. So as you might imagine, this is really looking at huge policy areas of the European Union and slicing them into proportion to cover sustainability, to cover innovation, and to cover, of course, new legislation. Next slide. Of course, sounds great in theory when you read the 20 pages of EU Green Deal. However, how will such an ambitious plan be financed? To finance the EU Green Deal, the EU published the EU Green Deal Investment Plan, which totals €1 trillion via 2 main financing schemes. And these are set out here: 528 billion from the EU budget and the European Emissions Trading Scheme will be devoted to EU Green Deal. The rest will come from the InvestEU program, which combines the 279 billion from public and private sectors to 2030. To ensure that support is available in the most affected regions during the times of transition, the EU has also launched the Just Transition Mechanism, which will provide another 100 billion euros. Inevitably, sustainable finance will play a key role in delivering the policy objectives under the EU Green Deal. Already in 2018, the Commission published 3 proposals for regulation reflecting the EU's efforts to connect finance with its own sustainable development agenda. The proposals include measures to create EU sustainable finance taxonomy, make disclosures relating to sustainable investments, and establish low carbon benchmarks. And Frank and Philip will be looking into these in detail to cover how they became law and, in fact, how industry lives it. Sustainable finance refers to the process of taking ESG considerations into account when making investment decisions. To assist companies, investors, and policymakers identify which economic activities can be considered environmentally sustainable, the EU has introduced a taxonomy regulation. So without further ado, therefore, let me pass on to my colleague Frank to actually discuss taxonomy in greater detail.
Thank you very much. Thank you very much, Raminta. So for the next couple of minutes, I will explain and talk to you about the EU Action Plan and the disclosure regulation and the EU taxonomy, as Raminta has already announced. Next slide, please. Raminta has already explained a couple of international developments that led to the European Green Deal, that also led to the EU Action Plan on Sustainable Finance, on which I'm going to explain in a minute. Further to the Paris Agreement, which you obviously all know, and to the United Nations Sustainable Development Goals, both which came into force in 2015, 2016. I would like to add one further international development, an international initiative, which plays, to my opinion, an important role in sustainable finance. That is the United Nations Principles for Responsible Investments, the so-called UNPRI. It is a 2006 initiative of the United Nations with large institutional investors who have the goal to incorporate ESG issues into their investment practice. 6 principles for responsible investments. I have pointed out one principle, principle 1, which says we will incorporate ESG issues into investment analysis and decision-making processes. And what we see in practice a lot is that large institutional investors, German investors, European investors, are signatories of the United Nations, of the UNPRI, and incorporate ESG issues into their investment analysis and decision-making process. And it is, again, it is an initiative already of the year 2006. We spoke about the UN SDG, or Agenda 2030, from 2016. Raminta explained, and we also spoke about the Paris Agreement, which has the goal to reduce global warming to 1.5 degrees Celsius. Next slide, please. Talking about the EU Action Plan on Sustainable Finance as of 8 March 2018, it is the European Union's response to the United Nations Sustainable Development Goals and the Paris Climate Protection Agreement on the financial sector. It is a 12 pages document, so it's actually not so difficult to read. And when you look into it and you look into the 10 different actions of the European Union, I find that there is one sentence that shows in one sentence the actual goal. Raminta spoke about the man on the moon moment. And when you look at it, it sort of makes sense, because it says reorienting private capital to more sustainable investments requires a comprehensive shift in how the financial system works. So what the European Union targets is nothing less than the intention to transform the financial system completely in order to shift private capital into sustainable investments. That's a difficult task. So if you want to shift private investments into sustainable investments, you obviously have to define what is sustainable, which is quite difficult. So again, the European Union has made up 10 actions to reorient capital flows, to manage risks from climate change, and to foster transparency. And action 1 is a classification for sustainable activities. The action plan says a unified European Union classification system, or taxonomy, will provide clarity on which activities can be considered sustainable, EU taxonomy. To give you a practical example on how difficult and how political this goal is, this can be seen on the example of nuclear energy. if you take out German newspapers currently, or these days, you can see the argument between the French side and the German side on the question whether nuclear energy is sustainable. There are good arguments, no carbon emissions, or whether it is the opposite of sustainable. It's more the German view, because you obviously might have a waste problem. So this goes into details on all areas of the economy, and the classification has the goal to define which activity can be considered sustainable and which not. Action 1 of the action plan. On the other hand, action 9 of the action plan is transparency. Transparency of asset managers and institutional investors on sustainability issues is a basic prerequisite for financial market participants to adequately assess their management of sustainability risks. This also makes sense because if you want to invest into sustainable investments, there must be transparency in the market, transparency of financial market participants on sustainability issues. Other actions under the action plan are creating standards and labels for green financial products, for example, or incorporating sustainability when providing financial advice, or, for example, integrating sustainability in ratings and market research. From my practice currently, the most important actions are the classification, the taxonomy, and the transparency, the sustainable finance disclosure regulation. But of course, there are only 2 actions out of 10 of the EU action plan. Next slide, please. Looking at transparency, the European Union SFDR, Sustainable Finance Disclosure Regulation, it is a regulation on sustainability-related disclosures in the financial services sector, dated 27 November 2019. And this regulation came into force this year in March. So in practice, we are already dealing with it. What is the goal of, or the plan of the SFDR? It is basically in our practice a subdivision of investment funds and other investment products into 3 major groups. There are the so-called Article 8 products, products with ESG characteristics in their investment strategy. It says in the regulation, among other characteristics, environmental or social characteristics are promoted in a financial product. The next would be Article 9 products, so-called impact investment products, financial products which has sustainable investment as its objective. So it has to be the primary goal of such a financial product to invest into sustainable investments. Examples out of my practice, solar parks, wind parks, stuff like that. Important is if you set up such a financial product, or you set up a such an sustainable fund, that those characteristics must be binding in the fund documentation. They must be measurable in the fund documentation, and they must be laid down in detail in the fund docu and in other documents. The regulation does not force market participants to invest or to set up Article 8 or Article 9 products. They only force you to be transparent in your fund or other financial product documentation. If you do not decide on an Article 8 or Article 9 product, your product is automatically an Article 6 product, so-called Article 6 product, for example, an investment fund without any ESG characteristics. And the regulation says, where financial market participants deem sustainability risks not to be relevant, a clear and concise explanation of the reasons therefore is required. So the regulation does not force you to set up a sustainable fund. But if you don't do it, you have to explain in detail why ESG matters do not concern you. And you can imagine from a marketing perspective, you don't want to see on the first page of your financial documentation that ESG is not of relevance for your fund. In practice, the subdivision between Article 6, Article 8, and Article 9 products is still difficult and still disputed a lot. On the other hand, the classification has a significant influence on the scope of disclosure obligations. What the EU says very clearly is that greenwashing should and will and must be avoided. That's the actual target, the goal behind to avoid greenwashing. But where exactly the border is between greenwashing and not greenwashing, and Article 6 and 8 and 9 is still difficult and open. So in an ideal world, we would recommend our clients to wait until the regulation is precise and all questions are answered. And then you could set up your Article 8 or Article 9 fund. But of course, the market does not have that time. And it is a good example to see how the regulation works, because the market runs ahead of the regulation. That's what we see in practice. It is a marketing issue. We see a huge demand in sustainable products in the financial industry, and the market participants run ahead. They have the goal, and they already do it. We have done it a lot this year, setting up Article 8 and Article 9 products. It is a bit easier to set up a financial product such as a stock fund where you deal with stock, because in this area you have various ratings and benchmarks, which stock you can still acquire and which you shouldn't for a sustainable fund. In my practice, I deal a lot with real estate. It is still quite difficult to define environmental characteristics and to find the border between Article 6, Article 8, and Article 9. What we also see is clever lawyers starting to challenge products, starting to argue that certain products are set up as Article 8 and Article 9 funds, but in fact, it is claimed that they might actually do greenwashing. So we also see first developments in this area. You have to be careful. You have to do it properly if you set up such a fund. Next slide, please. The second pillar, first was transparency, and the second is the European Union taxonomy, a classification, the establishment, as the regulation says, the establishment of a framework to facilitate sustainable investment. Now, if you look into the EU taxonomy, into the actual regulation, you might be disappointed because you do not find a definition of sustainable activities or investments. As we see quite often in European Union regulation, the regulation contains only principle-based objectives that an actual activity, investment, should benefit or not harm. You find in the taxonomy 6 environmental goals. Climate protection is obviously an important goal. Climate protection defined as climate change mitigation and climate change adoption. Climate change mitigations means the process of holding the increase in the global average temperature to well below 2%, 2 degrees Celsius, and pursuing efforts to limit it to 1.5% degrees Celsius above pre-industrial levels, as laid down in the Paris Agreement. Other environmental goals are sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, protection and restoration of biodiversity and ecosystems. And you might wonder now, looking at this, about the S and the G, because I've only been talking about the E. And then you see that currently the focus is very clearly on the E. We have the environmental issues and the environmental goals. The social goals and the government's goals will also be a part of the European Union taxonomy, but they will follow at a later stage. As I said, the regulation does not contain a definition of sustainable activities or investments. The actual classification takes place in the so-called level 2 measures or technical screening criteria. This is already a package of a couple of 100 pages, where for each economic activity you find, or you should find, whether an activity is sustainable or not. The European Union taxonomy comes into force, or essential provisions, on 1 January 2022, but then it will be in other steps also on January 23 and afterwards. The level 2 measures, what is in practice of most important for us, are unfortunately still in a draft stage, but should come into force in January 2022. Next slide, please. If you look at the European Union taxonomy and you search the criteria for environmental sustainable economic activities, you find a certain mechanism. An economic activity contributes, so the regulation says, contributes substantially or must contribute substantially to one or more environmental objective. That's a requirement on the one hand, and it must not significantly harm any of the environmental objectives on the other hand, and it must be compliant with minimum safeguards, for example, the International Bill of Human Rights, and it must comply with technical screening criteria. This is the definition, the requirements for environmentally sustainable economic activities. And in practice, I already mentioned it, in practice, the technical screening criteria, which are currently only in the draft stage, are of most importance for us in our daily business. To give you an example, for example, if you want to assess, to consider whether a property, whether real estate is a sustainable economic activity, the technical screening criteria currently say, for example, a building contributes to climate change mitigation if its primary energy demand is 10% below the national threshold for nearly zero emission buildings. That would be contribution to one environmental objective. And on the other hand, the do not significantly harm contest would be, for example, the building must obviously not be in an environmental protection area or not be in a national park. It must not contain asbestos or other comparable materials. So it's always the test. Do you contribute to one or more environmental objective? And on the other hand, the do not significantly harm test. Do you significantly harm any of the environmental objectives? And in practice, you look into the technical screening criteria, and there you will find the requirements for each economic area. Next slide, please. I have already mentioned the environmental objectives, climate change mitigation, and so on. And I have already mentioned that as of January 22, the taxonomy will only come into force with regard to the objectives climate change mitigation and climate change adaptation. The other goals will not be effective before January 1, 2023. So there is still a lot to come. Next slide, please. At the end, I would like to give you some practical issues that we are facing in advising on European Union transparency and taxonomy. The self-imposed deadlines for the introduction of new ESG regulations are often not met. The goals of the European Union are extremely ambitious. Raminta already mentioned it. And what we see in practice is that the European Union runs behind their own ambitious targets. Legal requirements for classification and transparency, unfortunately, only come into force at different points in time. For example, transparency, the regulation started in March this year, March 21, but there is still a lot of information missing and there are still a lot of open questions. But nevertheless, market participants already set up funds with a lot of questions still open. So this means that financial market participants must implement documentation in their products, even if specifications, important specifications, are still missing or only available in draft form. And on the other hand, the regulation alternates between attention to detail on one hand and large legally gray areas on the other hand. To give you an example again, the investor information for Article 8 and Article 9 products must contain a separate appendix in which the ESG regulated information is described in a detailed question and answer scheme. So you have like a 5-pager where you need detailed questions and answers. But on the other hand, it is still unclear which percentage, for example, of a fund's assets must meet ESG characteristics in order to qualify under Article 8 of the SFDR. This would normally be the first question: how much of my percentage of my fund's assets need to be sustainable? A question that's in large areas not answered. But on the other hand, you have detailed Q&A sheets, which you must amend to your fund documentation, whereas you still have a lot of open questions. This was a short overview on the European Action Plan on Sustainable Finance, Taxonomy and Transparency, Financial Disclosure Regulation, and some practical examples. And now I would like to pass on to my colleague, Philipp Grenzebach, on the CSR directive. Thank you very much.
Many thanks, Frank. I think it's really an arch we're doing here towards, what should be done and what is going to happen in the next couple of years. And one element here we learned is just like, Arminta was explaining what, materially, is to be done in the next couple of years. Frank explained, what will be the criteria where people should direct their funds to. And it was identified, a couple of years ago already, that transparency, on, the sustainability situation in targets, basically, so in economic actors, is vital, to make these decisions and to monitor, so information is missing. And I think we've been there already for a while. In 2014, or since 2014, we have the directive on the non-financial reporting. And if you just look at, how these pieces of legislation are named, you can already see, a development here. Historically, financial reporting was introduced to protect a certain group of stakeholders, and especially having their financial interests in economic actors, i.e. limited liability companies. And these limited liability companies had this privilege of a limited liability only if they disclosed some financial information. And this evolved into, all sorts of things like balance sheets and accounting. And when you look at the wording of the 2014 directive on the non-financial reporting, it's clear that, it's coming, from the branch of financial reporting, and it should add, another dimension, including other stakeholders than people you probably owe money to, but, society at large, because the hidden cost of your economic activity is very often linked to questions of sustainability, whether you use water or air or pollution or whatever. It's something you usually would not report on, but these are resources, that are, considered to be, used as well. So these, both like things you consume and the assets you use, should be somehow reported. And so from the non-financial reporting, we are now evolving with a proposal for a new directive on the amending of the original, directives and the law incorporating them towards a directive on corporate sustainability reporting. And what we expect here is, that there will be a whole new branch of reporting. On the one hand side, still the financial reporting, on your financial health of an entity reporting, but also on the impact this entity, whatever economic actor it is, will have on sustainability questions here. From what we see is 2014, this had an impact. It was implemented throughout Europe into national law. In Germany, you find it within the regulation on how to set up a balance sheet. It was integrated into international frameworks. And a lot of reporting standards like a UN Global Compact or others that have been developed over the years were used to make these reportings. There were different approaches in the last probably 15 years to this, saying that companies should not only report on their financials, but also on their corporate governance. And the corporate governance movement was originally intended to be extended to sustainability aspects as well. In Germany, we have, basically copied from the London City Code, the German Corporate Governance Codex, which implemented some soft law where listed companies are required to report on their corporate governance. Some 10 years ago, there was some movement to implement a German sustainability codex, it never came because people were afraid that it was impacting their corporate governance, for example, made decisions void or something like this. So basically focus shifted towards reporting, and here non-financial reporting, and now corporate sustainability reporting. What we expect is that the proposal the Commission provided in April 2021, so this year, it is now in the Parliament stage after various hearings from stakeholders, will come into force in 2022. And we also expect that already reporting requirements will start to be enforced already 2023. There will be some in-phasing and out-phasing of old rules, but still, I think this is the wake-up call for everyone who's been, waiting for this legislation to bite. It should be biting already because it's binding law already in all member states, and there's already fines to be paid if the reporting is not properly done. But still, the requirements what to report and the flexibility what to report is so great that enforcement is not happening in a grand scale. If we move to the next slide, we will give an overview what the changes or the material changes we would expect for if the directive is implemented as it's proposed by the Commission. First of all, the scope will be vastly different. At the moment, we have a end criteria. So it's cumulative of, if you see on the left-hand side, you must be a company with a balance sheet total of 20 million, net turnover of 40 million, and employees more than 250, and you must be orientated towards capital market. This is a very technical term for you're not listed, but basically you are like collecting your money in some sort of public capital market. So at the moment, the Commission estimates that 11,700 larger companies and groups across the EU are covered by the current legislation. And this is also reflected in the national laws. So you see the same criteria in the national laws. For example, I would see them in our German commercial code where the balance sheet rules are laid down. This will now change significantly. And the Commission expects that under the new rule, 49,000 entities across Europe will be covered by this. So if you're running a mid-sized business, you probably will be covered by this if it comes into force as it is on the table at the moment. So if you have a balance sheet total of 20 million, so that's kind of the same, but you're not required to be listed anymore. But all companies listed, are definitely in. So it's just like even small listed company in, and there will be some small exceptions. So we see already that, from, for example, small IPOs and, general corporate reporting, people start asking questions, and the regulators are asking for this reporting to be included, for example, in prospectuses or other financial statements. Again, we expect that this will turn out into a completely separate branch of reporting to be done in addition to the existing financial reporting. And we can see that on the next slide. The topics we report on are basically the ones we've been talking about in this session here. And so far, there's been quite some flexibility, and especially the standards to be applied were basically voluntary. You could pick and choose your appropriate standard, which would have ensured some certain quality, but this will not be the case anymore. There will be a specific content provided in the future. And as Frank already said, this is all work in progress. So we don't know at the moment how this exact list of disclosures will look like. So this is still going on. And all the non-mandatory standards that could be voluntarily applied, and you could say like, okay, I report under the UN Global Compact, will be gone. So there will be definite rules to say, telling you what to report. And in terms of taxonomy, here as well, the reporting standards and reporting formats, shall be unified in a way that they are electronically readable and that they really provide data and not just, you know, prosa in terms of reports that people need to read and analyze. So basically, they need to be tagged in a way that, you know, some sort of, you know, smart analytics will be possible. And, you know, all sorts of stakeholders, from state actors to investors to consumers, we should have a possibility to make comparisons between the actors in the market. And this is a huge shift in terms of transparency, because, you know, once you adopt a data-driven system here, it totally changes the game in terms of people are not able to hide anymore behind, you know, some nice sounding and good looking reports. You know, it will really break down to certain, you know, KPIs being reported. Okay, move on to the next slide. Still, there will be some flexibility where to report something, but given the number of things people have to report on, you know, it will end up some sort in a separate report, you know, separate from the financial reporting, at least for the bigger companies. So people should expect that, you know, they have to put extra efforts, probably, you know, in larger entities, extra departments in that, and be ready to deploy some resources on that. A completely new way of working together will be the audit requirement. So far, there was no obligation to externally audit the sustainability reports, but some of the firms opted to have some sort of auditing on it, which was not, you know, what you would consider hard auditing in most cases. But this is going to change as well. So auditing firms will have to, you know, change their scope as well as new firms will probably spring up, and on how, you know, this sustainability reports will be audited. Since these reports, you know, due to the taxonomy and other questions we've been discussing, will be more technical, you know, some extra expertise needs to be built up within these organizations reporting on this. And there will be a dialogue with the themes Frank covered before, because if people want to invest in it, you can expect some dialogue between people asking questions about these things. And, you know, the reporting formats will also evolve in a dialogue with the stakeholders, asking for these questions and, you know, grading basically into the investments they are doing. To the next slide. Currently already, you know, false reporting is already penalized within Europe, but also the expectation is, and it's in the current draft, this is going to rise, because at the moment it's very difficult for you know, any stakeholder to find out if any reporting was incomplete, false, or misleading. Due to the data formats, there will be more access for people to challenge information, to compare information, and see how this reporting is going. So we expect that the enforcement will raise. If we look at the statements surrounding the hearing process, everybody's expecting that these, you know, harder sanctions will not bite in the first couple of years, but will be increased, you know, over time. So this is mandatory law, and this will be mandatory law in all member states, and there will be some sort of enforcement in it. The whole transparency at the beginning starts to sound like a voluntary process of people, you know, giving the chance to the stakeholders to decide in what products or what companies to invest. But at the same time, the fact that you have to disclose, this is not voluntary law, that's mandatory law. People should adopt to. We can go to the next slide. As I mentioned already, the process is ongoing. We have the proposal on the table since April 2021. At the moment, we are in the parliamentary stage. We expect a lot of amendments to this because, as I mentioned, this will be, you know, a real game changer we're talking about here. But as I said before, everybody should expect the law to be effective in 2023, and we expect that the deadlines for the member states to implement the measures in the directive and in all the directives changed by it, in total 4 here, which is like auditing, financial reporting, and the transparency directive will be enforced very, very quickly. So I think the rush we are currently seeing, and we are quite aware that we are not the only firm in the world reporting on these things, is driven by these tight deadlines we're seeing here. So the implementation of the Green Deal Raminta talked about, there's a central pillar is the transparency and making available what is happening on the ground, and the transparency by the Sustainability Reporting Directive is a central element to that. And if I look at the time, we are already covered like the hour here. And so we're coming to an end here. Of course, all the 3 of us are happy to answer any questions on this. I think from what the topics we covered, it's pretty clear, that we have our certain areas of expertise. Raminta, of course, is really helping us on lots of material issues. Frank gave us an introduction to how the funds look at it in Europe, or will look at it in Europe. And probably I will be seeing a lot of activities, both in the capital markets as well as the corporate sphere, trying to adopt to the new rules and implement them as good as they can.
Thank you very much for your participation, and we hope to speak and hear and talk to you very soon.